All right, it's time for our interview today, and our guest is our old friend and colleague from Stansberry, Bryan Beach. Bryan, welcome to the show.
Hey, Dan, good to be here. Thanks for having me back.
You bet. We're always going to have you back. You're.
Yeah.
I mean, you're a value guy, so it's just like if I want a conversation that's not going to get too crazy on me,
Yeah.
I know I can count on you.
If Dan
But
gets
Yeah.
tired of me mentioning Bitcoin, you gotta,
Uh-oh. Yeah. 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 Bitcoin is not my shtick. In fact, I sold my Bitcoin ETF right before it tripled. So I called the bottom perfectly on that.
Yep.
So yeah, don't listen to me on crypto, people. That's some good advice.
Yep.
Listen to Corey.
Yeah, don't listen to me either. I've missed this whole rally. I was in it the first time. I think we bought in April of 2020 or so, and
I remember that. Yeah.
got a decent run out of it. But we missed the second run up here. But that's not what we're talking about today. Let's start with something that I realized was a value play originally, which is GameStop, and it's back in the news. It ran up again, double or triple or whatever in a couple of days last week, and of course it's in the news again and it ran up because the original analyst, a guy named Keith Gill, who calls himself Roaring Kitty on X, formerly Twitter, he reappeared Sunday night by posting an odd little picture of a guy sitting upright in a chair with a video game controller in his hand, and then followed it up with a bunch of other things that kind of said, I'm back, and with a vengeance, sort of. But this was originally like his handle on YouTube is deep effing value, right? This was a value play. He genuinely liked the stock. Do you remember that? I mean, that's what it was about.
Yeah.
Crazy.
Yeah, and it was a deep value play. He thought that the market was missing some value there, and gained a big following, and it became it took on a whole other thing. Dan, really, this was part of a big kind of smart money versus dumb money battle that played out in 2021. That I thought was really interesting to watch. I didn't really participate in it, but they made a movie out of it. I know, Corey, you just wrote about it. I can't remember the name of the movie, but I really enjoyed it.
Dumb Money. Yeah, well, you just said, yeah. And Ben Mesrick, who wrote the book, was at our conference in Vegas last year. Yeah.
Such an interesting story. And, Dan, you talk about me as a value guy, and I am, but I was oddly pulling for the dumb money, so-called dumb money, as I watched this play out, for a couple of reasons, I guess. I mean, I cheer for the 15 seeds and March Madness for the same reason, but going back to 2021, and I don't know how much background we need to give your viewers or listeners, but GameStop just kept going up as people kept piling in, and the smart money, the hedge funds mainly, kept going short, kept betting against it because the fundamentals did not support the valuation, right? So you would think a guy like me, who's a value guy, would be on the side of the people shorting it. But there was something much bigger in play here. This was about market dynamics. And I don't think the dumb money was nearly as dumb as people said. I think they understood how the market worked. I think they better than they got credit for. Some of them, certainly, I think Keith Gill did. And I don't think the smart money was as smart as it was. That's really a self nickname, by the way. I don't, the hedge funds and the banks try to, institutional investors kind of think of themselves as the smart money. I kind of find myself, I don't know how you feel, Dan. Myself kind of in the middle, right? I don't have hundreds of millions of dollars at my disposal like the hedge funds do. But I do a lot of fundamental research. I think most of my subscribers are smart people. They can afford a couple $1,000s for financial research. So they've made a nice nest egg for themselves. Probably, I usually think of them as like retired dentists and whatnot. They're just trying to learn more about businesses, learn more about how the market works. I'm kind of in the middle of the smart money, dumb money kind of thing. But what was so funny about GameStop is watching the underdog find this one little corner of the market,
Yep.
these one or two stocks where they could really punish the big guys. And that's been fascinating to watch. And of course, it went away. Keith Gill had to testify and went to Washington and all that. You guys know the story. But he's back at least for a week. He was back, and it was interesting to watch.
It was. I have been very critical of people who bought GameStop and AMC, but like after they soared to ridiculous, multi tens of $billion valuations. That's what I was critical of. Before that, I think the guy's like, it's genius, right? You find something you think is deeply undervalued that's also heavily shorted, and then go on Reddit and tell the world about it. It just makes all the sense in the world. It was quite brilliant. I don't think Keith Gill's an idiot at all.
No.
I think the folks who bought after that, the folks who hung on to it, they bought at those valuations, at tens of billions of dollars of market valuation. It's like the worst garbage in the market, and they're holding on to it like it's Berkshire Hathaway saying, apes not leaving, right? The folks who are buying AMCs, it's called themselves apes, and they said, we're not leaving. We're never selling the stock. And I thought that was crazy. And I still think it's crazy. That hashtag apes not leaving, they're back on Twitter. So
is that right?
Yeah. But I agree with you. It was a fascinating phenomenon. Definitely pulling for the little guy. I love that aspect of it. I love the David and Goliath.
It's like as an analogy. This might be dumb. You guys can edit this out. But you think of your high school, right, or any high school. There's like the geeks and the jocks, right? And it's like there's 1,000 places for the jocks to beat up the geeks, right? And thousands of lockers to be stuffed in or whatever under the stairwell. But it's like the geeks got together and they're like, the oak tree behind the gym. Let's all go there, right? Let's just all go to this one spot, right? And where they find some jocks there and they just start pummeling them, right? And then the jocks get scared. The jocks start calling their buddies over to the oak tree. Look at what's happening with that. And there's so many geeks there. They're well coordinated and they're just pummeling these guys no matter who's coming over. But they're smart, right? They know there's 1,000 places where we're going to get beat up.
Yeah.
But we found this one spot, and we're going to exact revenge or whatever, I mean, and I thought that the screenplay in the movie got into that dynamic pretty well. These people understood how the market is supposed to work a lot better than I think the super smart short sellers gave them credit. And at the risk of extending this analogy too far, in the end, the jocks kind of went running to the principal with tears streaming that, this isn't fair, right?
And taking away the buy button. Yeah.
Right. They took away the buy button and Robinhood so that the stock couldn't go up. And, the jocks got to dust themselves off and walk away from the tree. Relatively not unscathed, but
not at all. They were scathed. They were seriously scathed.
Some of the big guys were, but I think some of them made out okay. I mean, I don't think they made money, and now we're back, right? I mean, these guys are like, hey, I'm still thinking of that oak tree back there, guys. What do you want to do? I like I say, I kind of think of myself in the middle. I'm not smart or dumb money. First of all, I don't think the smart money is that smart. The dumb money is that dumb. I mean, I showed up at the tree, just kind of crossed my arms and kind of, grabbed the popcorn and watched it played out. I mean, it was fascinating market dynamics. Dan, you and I are big Ben Graham guys. We read Intelligent Investor every couple of years. Ben Graham could never have imagined something like this playing out, and so we got a real life lesson in in markets in real time. It was interesting to watch.
Yeah. Yeah. Fama and French couldn't have imagined it either. You know,
Yeah.
I mean,
Yeah.
um, you know,
We're living in weird times.
you can't say
Yeah, it is a
markets
great
are efficient
analogy,
and
that the jocks and the nerds analogy in the tree. I that's
Right.
one I personally have not thought of that, and so that's a really good analogy. I'm wondering what this quote return of Keith Gill actually means, if anything, like now, like what is, and is it?
You know, I don't know. I think a lot of the people that were following him got, most of them lost a lot of money, and they, I think they've seen. I don't know, Corey. I think that again, to return to the analogy, these jocks are going to get rescued somehow, right? And I think they're a little bit concerned about that, and I think as we're recording this, most of the gains have come all the way back down. I haven't turned on my Bloomberg this morning, but I don't. I think that what played out last week has already kind of died down. It took days, not months or quarters, for this thing to play out. But I'm gonna keep my eye on the oak tree behind the gym. Anyway, it's interesting and educational both.
yeah, interesting episode. I think it's funny that it's funny to me that the guy who calls himself Roaring Kitty probably just caused a huge dead cat bounce in these stocks. I just
I see what you did there. Yeah,
that tickles me to death. He shows up
Yeah.
and he says, and he's got all these sort of meme-like video clips, and about how he's back with a vengeance or whatever, and he's Roaring Kitty, and
Yeah.
like we all know that these companies, they're not in great shape. Maybe when GameStop was $1, it was like deeply undervalued, but not now. And
Yeah.
same with AMC. And AMC has done a much better job of like exploiting the rallies, and I
Yeah.
mean their share count is
Selling
up
into
like,
the
yeah, it's like 10 or 11x or something. I mean, it's huge, the difference. And they've continued to do it. They made another announcement last Tuesday. I think they announced Tuesday that they had already issued like another 250 million of stock, and then they announced Wednesday that they issued another, I want to say 160 million to swap for debt. I was like, yeah, that's what's happening there, of course, is that the executives are using the meme stock phenomenon to prolong their tenure, right? I mean, essentially,
Yeah, it's the same thing they did
well,
in 2021, right?
Yep, exactly.
it's what I would do if
Yeah.
I were on the board, right? If the ducks are quacking, feed them.
Yeah, you have to, right?
And I can't remember. This is on Twitter. I think Matt Levine wrote about this the other day. He wrote about a couple of things. It's like these guys, if you've got a struggling company, you need to hire Roaring Kitty to tweet about it, so that he can raise the price so that you can sell new shares and raise hundreds of millions of dollars like AMC is doing.
Yep.
But, one smart money play, and I've heard about, I don't know who's doing it. If a stock runs up to $8 and one of these meme stocks, you short it. This is if you've got a lot of money, if you're smart money, if you're buying, you short it at $8, call the board of directors and say, I hear you're trying to raise money. I'll pay, $7, right? So you've locked in $1 right there.
Yeah.
You've just, however many shares you shorted, you offer to buy new shares from the board of directors for $1 less.
Right.
Again, smart money is pretty smart. I don't know if anyone's doing that, but that would work. As some of these things, charge higher. Yeah. And Dan, I talked about this. I think the last 2 times I've been here, I talked about SPACs, which was a huge bubble in 2021.
Yep.
I've talked about software as a service, which is another big bubble in 2021, and kind of like Roaring Kitty, not really, but similar in one way. These stories are still playing out, right? They're not over. What is what is once overloved, is often ends up overhated. And as a value guy, I'm still looking and finding SPACs in the scrap heap there. And there's still an incredible stench around SPACs.
Mm-hmm.
Anything that came public that way, special purpose acquisition companies, if you're not familiar, and software as a service was super hyped by probably some of these same people who were getting excited about NFTs and roaring kitties and whatever in 2021. And those valuations are down, I think, too much. So I think I was on this show a year ago or something and talking about software as a service. It's still down. And so these stories, whether it's the crazy story about, GameStop,
mm-hmm.
or entire sectors like SPACs and software as a service, these things are still playing out. I haven't seen NFT story come up. Corey, you watch the news more than I do, but so maybe that one's actually dead. But a lot of these interesting things from 2021 are still playing out,
right?
For sure.
Yeah, NFTs actually trying to make a little comeback here. So along with the meme stock, so you wonder what this means about just market sentiment at this point in general. But it's. Yeah, I mean, I wouldn't be personally. I'm not touching NFTs with my keyboard or fingers or whatever. However, you can touch them.
Yeah. But other than that, I think a lot of these crazy stories from 2021 are still kind of playing out.
When you talk about SPACs, do you mean SPACs or de-SPACs, like post-acquisition? SPACs that have merged and been, crushed.
Yeah, I talk about de-SPACs. I mean, what happened in 2021 is hilarious, right? So let's talk about smart money. This is smart money being smart. In fact, I was just cleaning out my desk. I found something I printed in 2020 just this morning. So just to back up a little bit, I know you know this, Dan, and Corey, you've been writing about it. A SPAC is a shell company goes public with nothing but cash, right? They've got sponsors, and they go public with nothing but cash. And then they go find a business to buy and merge with. And they can take that private company public just by buying the business. So Dan Ferris Podcast Inc. or whatever, Corey NFT World or whatever, right? So you've got this shell company with cash, and you go out and merge with a business. Interesting thing about SPACs is the people who raise the money are able to redeem that money anytime kind of before the acquisition happens. And then they get some free warrants on top of that. They just need to recruit some people to buy in with them. And that's where the retail investors or the small time guys, I'm not going to use the word dumb money, but that's where the retail or small time. So they needed to go out and drum up interest for this. And one of the ways that they did that was by convincing people that the SPAC is a backdoor way to screw the big guy, right? To screw the smart money. And so that's some background. This is something I came across that Matt Levine wrote. I guess it was around 2021. I cannot get over how good the recent trend to cut banks out of IPOs has been for the banks. It is one of the great scams of modern finance. People got mad that investment banks get big fees for taking companies public, so they said, what if we found a new way to go public, one that reduced the power of the banks? And the banks put on trench coats and took out mustaches and went to companies and whispered, you should do a direct listing or go public by a SPAC. That'll show those evil banks, and then
that's right.
The context of this, right? So it's the same thing. The banks are still making money, right? And the hedge funds who raise the money, they're still getting rich. Yeah. The context of this was he wrote this in the middle of like a run where every single bank was having record earnings, right? And they're like, and meanwhile, these banks have mustaches on and trench coats and are like trying to convince people that that they're screwing the banks. That was a story that sold in 2021, right? And
Yep.
what happened is the smart money, they would redeem all the money out after it, and the retail investors the small guy just got clobbered once the de-SPAC happened. And they would overpay. Dan, as a valuation guy, there was so many SPACs and so few decent private companies. So they were overpaying for these companies.
Yeah.
And then when the SPAC de-SPAC, that's when the merger happened, when the actual merger,
Yeah.
eventually reality sets in and these things go from $10 down to $4 or $5 or $2 or $3 or even lower. As a value guy, listen, people smarter than me figured out a way, to try to, pick which SPACs were going to go up. That was a strategy. That was, as a value guy, that was not my strategy. But if that's what you're doing, more power to you. And you're a smarter guy than me. I waited till they all fell and was trying to pick through the wreckage. That's a whole section of my microcap portfolio is SPAC splats. Of course, you've got to give it a cute name. SPAC scrap heap or SPAC splats. Anything that came public via SPAC, including stuff that happened, that there's still SPACs happening today in 2024. And the market just hates it. The stench is there, and they're selling these things off, and there's some decent companies in the wreckage. And again, I kind of watch that from the sidelines. I recommended the first SPAC I recommended was back in 2017, way before this was a hot topic. And so I kind of watched from the sideline the bubble, and have been able to try to pick apart, some just. It's a hated sector, and trying to pick up some decent companies out of the wreckage.
Yeah.
Just to go back to the lame analogy, that SPACs is a place where the jocks absolutely pummeled the geeks. I mean, they just and they convinced the geeks that they were winning.
That's right. It's obvious, right? It's obvious what happens here. A couple of smart guys go, hey, you know something? It only costs a couple of $1 million to do one of these SPACs. Let's do that, and let's raise a few $100 million, and let's just buy any damn thing and take it public, and then we'll own 20% of something that's worth hundreds of millions, maybe billions even, and we'll sell our SPAC shares, and that'll be that. And then, by the time we're out, the thing's down 80 to 90%, but we've made, way more, multi-bagger above what we spent to create the SPAC, right?
$2 million, to set up a public shell.
There you go.
And maybe less than that.
Yeah.
And that's why they were overpaying, Dan. Mm-hmm. I mean, you don't mind owning 20% of an overvalued company. It's better than owning zero.
It's not your money. Yeah.
And if the little guy got hosed, I think, mainly in that sector. And so now, Dan, in 2024, those of us who are looking at small caps, and I know that's not really your neck of the woods, but there's still some interesting stuff there. That's the best performing part of my portfolio for sure.
Yeah, I have done a similar thing. I did it unsuccessfully. I thought the cannabis bubble had been absolutely destroyed beyond a shadow of all doubt. I think it was down 60 or 70%. Of course, then, it went down 80 or 90 or whatever. And tried to buy MSauce, the big ETF. And we got stopped out of it because we were, if you buy something down 80% and it falls 90%, whoa, you've been crushed, right? So
I've got a couple of cannabis stocks too. Again, it's an advantage when I'm able to buy little companies that you probably can't with your file, with your letter.
Exactly.
But I do think cannabis is coming back. I'm up on, I think, both of them. One of them's up pretty big, and it's a company that makes it safe to do banking for cannabis companies to bank. There's all kind of regulations around that. So when when cannabis got rescheduled as kind of, or is probably going to be rescheduled as a less dangerous narcotic for federal purposes, I think a lot of these cannabis companies are going to come back. So I don't think you missed it. You maybe were just a little bit early. But you stopped out, huh? So you're using stop losses in your portfolio all the time now, or I know
Yeah,
you've gone back and forth on that a bit.
yeah. I mean, sometimes we do, sometimes we don't. Sometimes we just start out without one, and then we don't. If we don't like the way things are going, but we are not ready to call it, we'll put in a hard stop at some level and say, okay, well, if the market says it's worth less than this, then we're going to call it a mistake.
Yeah,
But it's not. We're not religious about it in the extreme value letter. I used to never use them at all, but
I remember that.
yeah, the truth of our business is not pleasant, and that is, if people, you could be the greatest stock picker in the world, and if people subscribe to your newsletter and they get their first issue and they look on the back page of your portfolio, if they see minus 30%, 40%, whatever, they think you're stupid, even though it doesn't mean anything remotely close to that. You know.
Yeah, I think you're stupid for other reasons.
Yeah, I know. That's right. I'm not saying I'm not stupid. I'm just.
Nah, I'm kidding.
I know. That's right. He kids because he loves, folks. But I
You're going to edit that out. It doesn't matter.
yeah, that's fine. We've just become more selective about it because, and we're wrong sometimes too. Let's face it. I mean,
Dan?
PayPal was a disaster, and we had to get out of it. So we're wrong sometimes. We have to admit
The
that.
thing I like about
Go ahead.
I was just going to say the thing I like about stops is it takes emotion out of it, right?
Yep.
As value guys, Dan, we I can't remember who said it, maybe Buffett, but I think it was Peter Lynch. If you like a stock at 20, you're going to love it at 10, right? Like it's kind of baked into our DNA that if it goes down, that's a good thing. You should put more of your money into but that's a hard way to run a business or run or pick stocks. And it's a good way to stops are a good way to take emotion out of it, and just let the market tell you if you're wrong. I will say this: some of the tiny companies we do only have some down to like 100,000 in daily trading volume, really small. So we can't tell 2,000 people to put in a stop loss at the same. If 2,000 people stop out of some of these stocks at the same time, it's going to destroy the market.
Yeah.
But what we started to do is to set up, and we call them guideposts.
Mm-hmm.
So if I like a company because it's growing and it's got a strong balance sheet and it's cash flow positive, whatever I like about the company, I'll set up quantitative guideposts so that it helps me take emotion out of it, just like a stock price, right? I mean, so look, I'm looking for 20% growth per year. If the first year it's 12% and the second year it's trending towards 8%, I got something wrong. I need to sell, regardless of what the stock price is doing. I liked this company because it had a strong balance sheet. If they take on a bunch of debt to buy a company, I'm out of it. The things have changed. They start losing money. This happened to me recently with Dole, which is of course a household name, but it was down there in kind of small cap world. And they had one segment that wasn't really doing all that well, but they were going to sell that segment to Chiquita, another household name.
Mm-hmm.
And I liked the idea because I thought that their other segments were making more money. They sold that one segment to Chiquita. They could use $200 million, pay off the debt. I loved the way it was going to play out. I still like Dole, but the regulators, I think it was the DOJ in this case, blocked the merger, right? And so I went ahead and sold. I'm like, my thesis is no longer in play. So it's kind of like a stop loss in that you're trying to take emotion out of it. It's a quantitative thing. Like they did, this merger didn't happen, or the cash flows are drying up, or whatever. But left to my own devices, I'll just be stubborn, and stay in some of these way too long. So that's one of the things. I have to play it a little bit differently in the microcap world, but that's how I've been handling it. Interesting that you've come around and started using them. I know for years you didn't.
Yeah. I mean, of course, there was a famous bit of research that people talk about where they applied religious trailing stops to the extreme value portfolio retroactively, and they said, well, the performance is better than what Dan got. And what they didn't tell you was that, like, if you had never sold anything, it would be pretty damn good too. So
Oh, really?
yeah, I mean,
I
so
remember that study.
yeah, I
Yeah.
mean, I'd have a ton of 10 baggers, multi baggers if I just had left it all alone, you know.
Have
So
you ever looked at um, Amazon since '98? Amazon is up, whatever it's up. I don't
yeah,
even know, 30x, 100x,
yeah, couple
way more
thousand
than that
x,
actually.
couple
Yeah,
thousand
way
x.
way more than that.
Yeah,
Any year you want to pick, it's up 30, 100, 1,000.
yeah,
But it's had 10 or 12, 80% drawdowns over that time. And
yeah,
don't quote me on that, right? I mean, I'm making this up, but I mean,
yeah.
especially when it was a smaller company, you would constantly have been stopping out on Amazon.
Yep.
So
And
it,
it's a huge multi-bagger from the .com peak,
mm-hmm.
right?
Yeah,
Even though it lost
yeah.
90% of its value in the bear market. So yeah, and I thought again, don't quote me either, but I thought it was like at least 10, 35% or greater drawdowns. And 25, 35%, those are like typical trailing stop kind of levels. And yeah, so
I wrote about this a couple years ago, and I think it was more than that. I think
yeah.
they fell more than that, and I think it was
Oh,
more than 10.
okay.
I was looking over the course of its whole trading history, not just since the
Since
.com bubble
since
or,
right.
whatever, but
Yeah. I
the
looked at
it,
Costco in that respect, and I was like, wow, minus 70%, minus 50%. It was like, whoa. And of course, it's done
yeah.
great too. But yeah, you got to know that that's the way to hold on to those can only be to focus on the fundamentals of the business, right?
Hmm.
You can only
Yeah.
do it that way, because if you try to gauge it by the stock price, you'll say, well, the market knows something I don't, and I'm down 80%, so I must be wrong. Rather than the
I'm not
you
sure a
know
value guy ever would have bought Amazon. I mean, they were always,
yeah,
Bezos was always kind of investing so much that there was never really cash flow.
right,
Um, if I'm being perfectly honest, I don't know that I ever would have bought in.
yeah,
Maybe I would have after a big drawdown or something, but in
yeah.
any case, I didn't. And
No, no, the
here
value
we
guys
are.
did
At
not
least
want
not
it.
in my
That's
portfolio.
that's right. They focused too much on current profitability and stuff. And the one thing that you could have done was read that first shareholder letter. And he talks very much like it's like all the things Warren Buffett wants a CEO to say. you know
Mm,
and if you read it, he's like, we're going to maximize cash flow, and we're not going to worry about gap earnings and all that kind of stuff. I don't know if that's exactly what it says, but that was the gist of it. And I thought, wow, I had it right there in front of me in the first letter, and I whiffed it. I didn't take him at his word. So
I have to look that up. I haven't.
yeah,
I haven't ever
yeah,
seen that or read that.
yeah, I think it's from
That's interesting.
1997, if I'm not mistaken. Yeah.
Yeah.
So there were signs, but I agree. Like I looked at it a bunch of times, and I thought, I don't get it, because I was just doing the normal stuff that a value guy does. Um,
Hmm.
but and I did something yesterday. I was just dorking around in Bloomberg, and I was looking for companies that reduce their share count a lot over time, because I'm doing this little bit on Henry Singleton for my other newsletter, that'll be out in several days here. And I was looking at all these companies that made huge returns. I just typed in, like, $1 billion market cap or more, total return of greater than 100 or greater than 500% or something in 10 years. And so I had all these, 10 baggers, multi baggers and stuff. And like the first 7 or 8 of them, um, their share counts like soared over the period. They weren't
Interesting.
buying back shares, they were issuing
Right.
shares. They were in growth mode, right? Which actually, if
Yeah.
you study Singleton, Teledyne was in growth mode, issuing lots of shares in the first decade or so of its existence too. So there's that period. Um, so I was like, yeah, those are the ones I should be looking for, right? The ones that are issuing shares and growing like weeds and have good businesses, maybe. things.
Can I throw out a name? I
Yeah,
don't know if I'm allowed to do this.
of course. We love names.
I've mentioned this. I've mentioned this company. So, and I did a presentation on this guy. So, PAR Technologies is a software company, and as I've already kind of said, I really like PAR.
Okay.
I bought it, I think, in 2018 or 2019. It has this weird military consulting business that no one really knows what it does because it's it has contracts with the military. But they also sell restaurant software and hardware. I'm not exactly. There's an origin story about how it ended up in those disparate businesses. But when we bought it, the software company was kind of hidden, and that's one of my favorite stories is a hidden asset. And a guy named Savneet Singh bought in and ultimately became CEO. He's an investor, and I mean, Dan, if you read what this guy says, there's a podcast out there. I can give you the link. Y'all can link it if you want, but it's from several years ago. But he says everything you would want to say, and he and his buddies were sitting around, in 2017, 2016, I don't know when, and they were like, if Warren Buffett were our age, and at this point they're probably in their early 30s, what would he be excited about? What business would he be excited about? When Warren Buffett was 30, he was excited about newspapers, right? And there were things that
insurance, yeah.
What would he be doing today? And they were convinced that he would be in software, and especially subscription-based software. And the economics there, I've talked about it, I think last time I was here or something, but we can drill into that if you want. But at the risk of rambling, he says all the things you want. I mean, he's a Buffett acolyte, and now that he's running PAR, he keeps buying up other businesses around restaurant software, right? So that the software that schedules that schedules the wait staff, that schedules the kitchens, the software that especially processes your payment, the software that the software that takes the order that comes in from one of the external order,
PAR. Did they create PAR Tender? I know that software.
I haven't heard that one. It's called PAR Tech in the industry. I know you got some restaurant background yourself, but these guys, Brink Software was kind of their first software company. But he says all the things you're talking about, and after every earnings call, the stock falls because the cash flow, the profitability that people were finally hoping for isn't there because he's investing. He's reinvesting, looking for returns. And I can't wait. I'm up, but not a lot. I think I'm up 60% over years. I'm probably trailing the market. And of course, during 2021, I was up 4x and didn't sell. So I don't have a stop loss on PAR. But it's what you're talking about. And I could be wrong. Have me back on the show in 2028, and we'll see if this played out the way I think it might. But he's saying a lot of the things that you're talking about. And they're issuing shares. In 2021, when the stock went straight up, the ducks were quacking. He fed them. He sold a bunch of shares. Share count is going up. It's everything you just talked about. And this guy Savneet Singh is a really smart guy. He's my favorite CEO in the portfolio that I'm running. So in my publications model portfolio for sure.
And the ticker is PAR. So folks can look it up.
Easy to find.
Yeah.
Easy to find.
Yeah, and I just want to say that's one of my favorite things about reading Venture Value is, these stories that and interesting companies that you come up with. Just it's always interesting, like the origin stories of the businesses themselves.
PAR has a crazy story. I mean, I think the guy years ago, he had a contract. I'm messing it up probably, but years ago it was a family company, and a guy had a contract with the military, back in Vietnam era. And then as the war was cooling off, his buddy who owned a McDonald's, needed a cash register. And so he kind of pivoted into that as a side hustle. And they ended up with every cash register in a McDonald's came from this company, and that's the hardware side of the business, right? That's not the exciting part of the business. The margins were very low, and I don't know but now they've got all this hardware out there, all these fast food restaurants, and those are potential software customers, right? So they're not making a ton of money, I don't think, on the hardware side of the business, but they've got this big installed base of customers who know them, and they can try and sell them on the software side. Crazy story that the family sold out mainly to, I think, Savneet Singh's group and some others. But that family was on the tail end. They were selling out basically when I first recommended. Crazy story. All these little companies have crazy stories, right? For sure. Nothing. If the stock picks are bad, you'll get some good stories out of Venture Value for sure.
Okay, fair enough. All right, Bryan, it's time for our final question. Final question is the same for every guest, every show, no matter what the topic, even if it's a non-financial topic. It is the identical question every single time. And if you have already said the answer, by all means, feel free to repeat it. And the question is simply, if you could leave our listeners with a single thought today, what would it be? What would you like it to be?
Well, I mean, this is a financial podcast. There's a lot going on in the world today that scares me, and that's got my attention. We're here at graduation season. I don't know when you guys are watching this. Maybe you watch it months later, but all these protests and all the stuff around the world happening, that's where a lot of my thoughts and prayers are always. In the markets, there are ways to try and, it seems kind of grotesque, but I mean, we have a few picks in our portfolio that are going to do well if energy crisis happens, and given where there's some global conflicts right now in Eastern Europe and the Middle East, we think that could be an interesting place to look. I know you're talking to Cactus in the last episode about that kind of thing. Mm-hmm. I think that there's some interesting stuff there. Also, sticking with the financial theme of this podcast, Warren Buffett recently repeated, I know, Corey, you were reminding me of this. He thinks he could double his money in small caps. I don't know if I read it right, but he said that before.
Yeah.
And the opportunity there, I've been saying this for years, and I'm saying this for at least 2 years. Small caps just haven't participated in the rally the way the rest of the market has, as the Magnificent Seven has taken off and everything. And at some point, I think that's going to correct itself. I think that the gap is going to close, and you're going to want some amount of small caps in your portfolio. I don't think I could go 50% a year like Buffett thinks he can. But even if I do half as well as Buffett, that's still pretty good. 25% a year in small caps as that valuation gap between small caps and the rest of the market closes. That would be interesting. So your listeners can check out my letter, or if you're not interested in that, figure out a way to get some exposure to small and micro caps, because I do think Buffett's right, that there are some opportunities in that corner of the market. It's not really popular at all right now.
All right. We need to get Roaring Kitty to just recommend the Russell 2000 or something.
Yeah, or PAR. I should get him on PAR. Yeah.
Sounds like we should get the CEO of PAR on this show. That's what we should do.
Oh yeah. That would be a really cool guest. I'll send you a link. I've never talked to him directly, but I know some people. Maybe we can make that work. It'd be fun.
Yep. All right, Bryan. Listen, it's always a pleasure to speak with you. Thanks for coming. You'll be invited back soon, as you always are.
Okay.
Thanks very much.
Great. Thanks for having me, and we'll see you guys soon.
Yep.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.